Perfect. So thank you so much, Zach, for being on the call. So Zach is our contact at Quest Trust Company, and definitely would love to have you on and share with our audience, share with our investors, especially on the American side, how they can leverage their IRA to invest into, not just our deal, but also other syndications, other opportunities that are widely available in the market. So why don't we spend some time to talk about, your background, Quest Trust Company, as a firm, and we can start from there.
Absolutely. Yeah. Thank you so much for having me. It's kind of something that not many people realize they can do. Like you had mentioned, before, it's just people kind of think that their retirement account is only going to consist of either an IRA that they can put into the stock market or the 401k that's being managed by someone, and they're just you cross your fingers and hope that it grows as fast as you want it to, right? And so, anytime we get to introduce the idea of actually self-directing and taking control of that retirement account, we always like to bring it up. So I'll go ahead and share a slideshow real quick.
Awesome.
All right, so we'll take a look at multifamily investing within a self-directed IRA. Before we get any further, keep in mind, it's important to understand the role that Quest will play when it comes to the IRA investments. We're really here to facilitate whatever transaction you guys need and offer as much education and as many resources as we can. That being said, Quest doesn't offer any sort of tax, legal, investment, or structuring advice, nor do we endorse any specific investment. So for those of you who don't know us, we are Quest Trust Company. We are the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country, all 50 states. We have just over 2.7 billion in assets under administration. I think that number is actually a little bit outdated. If I'm not mistaken, we're closer to the 2.9, almost about to hit our 3 billion. So we're hoping that keeps going up. And we have over 100 employees, 34 of which are certified IRA service professionals. So what does that mean? So first, one of the things that we pride ourselves on is that whenever you give us a call, you're not going to get an answering machine. You're always going to get someone who picks up the phone and can answer just about any questions you would have. And if you want to take a deep dive into like the nitty gritty stuff when it comes to your IRA, we have 34 certified IRA service professionals on staff to take that dive with you. And as it stands right now, we have $450 million in undirected cash in your clients' accounts, right? That's the opportunity. Whether it's someone looking to raise capital or part of that current Quest pool, that's where the opportunity is going to lie. So one thing I always like to introduce, and Martin, by all means, ask questions as we go along, questions that you're hearing from your investors. But one of the common things is really, what is a self-directed IRA, right? In general, believe it or not, just a marketing term. That is just there to illustrate you're the one in control of the investments. Right, so there's no legal distinction between your self-directed traditional or your self-directed Roth IRA here at Quest versus the traditional or Roth IRA you would have at Fidelity, Charles Schwab, TD Ameritrade. Right, they are completely identical. The only difference is the custodian. Right, those custodians let you take those funds, put them into the public market. We allow you to take those same retirement funds, put them into privately held assets, specifically real estate style investments is what we specialize in.
It makes sense. Yeah.
So, right. And now we know that we're kind of dealing with the same retirement accounts. Why self-direct, at all? Really, there's several reasons, but we like to focus on the main three. The first one just being the true diversification, right? Usually when you're talking to someone about their retirement plan, they want to diversify their portfolio. It's about going into certain maybe index funds, certain mutual funds. You want to buy maybe some higher risk stocks that you think can actually, can grow, and you're looking to take advantage of that growth. And, maybe when the market takes a downturn, you shift towards bonds. But whenever you're doing that, you're kind of just putting your eggs in different parts of what is overall the same basket, right? That public sphere. And so what a self-directed IRA allows is to get that true diversification outside of the public space, right? Going into alternative assets, privately held investments, right? So that's what a self-directed IRA at a custodian like Quest allows. The second big advantage can be the tax savings. So whenever you're looking to make an investment, right? So let's say, I'm sure everyone's here, you're a real estate investor. And so let's just go with kind of the first real estate investment everyone gets introduced to. And let's say it's a fix and flip. Well, if you do a fix and flip personally, you make the investment, you pay for the contractor, the construction, you sell it for a profit, and you get those funds back. Either you're taxing those funds as you make them, or you try to put them into a 1031 exchange and defer that taxation till later. But When you do that, you're restricted on the types of investments you can do after that, the value of the investment, and also there's usually a timeline as to when you'll need to get that investment through. But with a self-directed IRA, it's actually going to negate the need for that 1031 at all, because by definition, by their very nature, these accounts are growing either tax deferred, or in cases like the Roth IRA or the ESA, they're growing entirely tax free. So notice we get to make those investments. We get to receive that profit fully back to the IRA and invest them as you see fit without any sort of restrictions. All right, so it's one of the big advantages. And finally, investing what you know best. Everyone on this call right now either has some real estate experience or they're looking to build that foundation and get into the real estate space. So with that being said, why not utilize that information, right? Why not utilize the knowledge base that you've built to actually take a hold of your retirement and start building it the way you want it to, the way you envision? All right, so it's pretty simple, to be honest with you, when it comes to actually setting it up and getting everything funded. So how do we go about funding an IRA? I know I'm kind of rushing through these. I want to leave room for us to be able to, go back and forth. And so how do we fund it? There's really three main ways to fund an IRA. The first one, it's just going to be contributions, right? The amount that you're able to put in just from your own pocket. Now, that contribution limit is going to depend on the type of IRA that you open up, right? They can range from, as little as, 38, in some cases 2,000, all the way up to 66,000 in a year, just depending upon the type of IRA that you have. The second one, it's going to be transferring from a current IRA. Right. So if you've got the IRA held up, a lot of times what we'll see is that, when someone was younger, they were told, oh, set up a Roth IRA, and just let it grow because you want to get that clock started. Awesome. Let's say you've set that up. You've been making your contributions. It's slowly been growing over the years. Perfect. Bring that over, transfer that over to a self-directed IRA here at Quest and be able to invest it as you see fit. And finally, the third and most common one is going to be a rollover from an old employer plan. Now, this is going to be funds sitting in a 401k, 403b, TSP, TRS, whatever it is, at a past employer that you've left, and now you're just looking for how to deploy those funds. It's super simple to just get those rolled over from that account over to your IRA here at Quest. Now, notice I underlined old there. Can you do it from a current employer? Maybe. That's the best answer I can give. It's just going to be really depending on the actual plan and the documents themselves. All right. So for example, if you have a 401k, you'll want to check and see if they allow for what's called in-service withdrawals, to see if they even allow for you to roll funds out while you're still actively working for that employer. Even if they do, there's certain parameters. Sometimes it's only when you're 59 and a half, so retirement age. Sometimes it's whenever you are fully vested. All right. So it just depends from plan to plan. So if it's a past employer, super simple, not a problem. If it's a current employer, you're going to have to ask some questions, and it's not going to be absolutely guaranteed you'll be able to roll the funds over. But once you've got the funds in there, how do you go about making the actual investment itself? It's pretty straightforward. We like to keep it very simple here at Quest, just because we realize there can be a lot of moving parts. And so what we're going to do is you just reach out to us, let us know that you're ready to make an investment. From there, what we're going to do is we're going to assign a specialist to you that's going to focus on whatever type of investment you're looking to make. So in this case, be a multifamily investment. So perfect. What's going to happen is our private entity team is going to reach out to both the client themselves as well as the syndicator. Right. So in this case, it'd be you guys. They'd reach out to y'all to help gather up the documentation, be looking for like that private placement memorandum, subscription agreement. We audit to be sure it's vested correctly in the name of the IRA. And we're also being sure there are no blatantly prohibited transactions putting the account at risk. Believe it or not, that audit process simply takes 24 to 48 hours. All right. So once we've got everything in good order, 24 to 48 hours, we can have it audited and the funds sent out and deployed. And now the IRA will be holding that asset within the account here at Quest. It's not uncommon for there to be some mistakes, especially the first time. Perfectly fine. There, we see it all the time. We'll work directly both with the investor and with you guys to help, let you know what corrections need to be made. Like, hey, no, we actually need this information, or it needs to say this specific vesting. We get a turnaround pretty quickly. And so that's usually not a problem at all. That's really the overall investment process here at Quest. I don't know if you had any insight kind of from your experience.
Yeah. So I had a few questions, both as a syndicator, but also for our investors as well. So for operators who has a syndication offering, do they need to make certain changes to their offering documents in order to accept IRA money?
So no, no, not that I'm aware of. Really, the same subscription agreement that you'd be giving out to all of your other investors will still work for us. The most important thing is going to be that vesting, right? What the name of the IRA is, just because when we're dealing in a retirement account, it's got to have a very specific vesting. So in this case, it'd be Quest Trust Company, FBO, client name, IRA, client account number. Right. So as long as that specifically says it on there and the Quest information is listed, like, our email address, our physical address, so that, anything can be mailed over to us, stuff like that, then we're good to go. We'll send it to the client for their read and approved signature, because we'll never make an investment. We'll never send out funds without getting that read and approved. And then finally, we'll sign as the authorized signer on the IRA, after which we can send the funds out.
And there's no attorneys that need to be involved for the actual self-directed IRA part, because you guys are the mediator. You guys are the one that's handling the IRA, the registered funds, and you guys as a platform are helping the investors invest into these private offerings. Is that correct?
Right, right. So best way to think about it is that, why the IRA is filled, let's say I had my IRA looking to make this investment, right? So while the IRA is filled with my money, it is an entirely separate entity than me. So it's got its own name, its own address, even got its own social security number in the form of an EIN. So really what we're doing as the custodian over the IRA is just facilitating that transaction. Any IRA can do this, even your IRA at Fidelity, it can make this investment. The only thing is that Fidelity as a custodian, they just don't have, it's not administratively feasible for them to do it, because it requires going through documentation, and they've got millions of clients, right? That's just not really realistic for them to do that. They deal with securities, whereas us, this is our business model. We focus on this, and so we've modeled it around it. And so that's really why we're here. We're really here to be sure that, like I said, that vesting is correct, to protect our client, being sure that down the road when a payment comes back, there couldn't be any argument that the IRS makes saying like, oh, actually, no, hey, this was listed under your name as an individual, and now this is taxable and not in your IRA. All
Right.
right. Also checking those prohibited transactions, just because that's the nitty gritty tax code, right? While we're not CPAs, we do read the tax codes for things like that. IRC 4975 is where specifically it addresses prohibited transactions. And so we're looking at those guidelines to be sure that, hey, none of those disqualified parties are showing up on this investment at all.
Yeah, and I appreciate you guys doing that due diligence. That's great. For our investors, for the limited partners, it sounds like as long as their money stays in the IRA, stays within the account, they're not taxed on any gains whatsoever. They don't have to worry about 1031 exchange. Right.
Right.
Yeah.
Right. So what's happening is, the funds are coming back directly to the IRA as an entity. It's never touching their hand. So they're not having to report any sort of income, taxation that they're having to pay or anything like that.
So when we issue our K1s as the operator, and when the investors file their taxes, they're simply telling the IRS that, hey, like, here's how much my investment through the IRA yields, and there's essentially they're growing their retirement savings tax-free.
Exactly. Now, the K1 will play a role with these investments, and it's kind of something I want to take a look at here on the next slide. It's kind of what that looks like, right? What is the K1 utilization within an IRA versus you as an individual?
That'd be great. Yeah.
Perfect. So we'll take a look at that. First is I like to introduce the idea of UBIT or UDFI specifically. So let's take a look at what happens here. So in this example, you have an individual buying an IRA, and then their individual buying a house, and then their IRA purchasing a house, right? So in the case of the individual will pay for the property, right? It'll put their name on the warranty deed, contract, all that stuff. Same thing for the IRA. Process the exact same, just different information. Now, when the property is flipped and sold for a profit with the individual, taxes are taken out, unless obviously, like we talked about, you go through a 1031 exchange to kind of push that back. With an IRA, though, it comes back free and clear. There's no taxation taken from it, right? As long as the IRA outright purchased it, there's nothing affecting all of the income coming back. Now, let's take a look if something was debt leveraged, right? If the IRA had to borrow funds to purchase a property.
Yep.
So in this example, Same thing, the IRA you set up the account, so the IRA is now in existence. We establish it, and it now borrows funds, whether it be from an institution, from a hard money lender, whoever it is. So it borrows funds, it then purchases that property. All right, in this example now, again, property is fixed up, sold, flipped for a profit. Well, because the IRA borrowed funds, the IRS sees this as too much of an advantage. It says not only are you in a tax advantaged account, but now you're utilizing someone else's funds to do your business, right? So they say, well, we're going to trigger what's called UDFI. That's unrelated debt financed income. Right? This is an income that the IRA receives that brings on UBIT. That's an unrelated business income tax. All right, so how it's going to work. Let's say in this example, it was a $100,000 property and 70% of it was debt leverage. So they put 30 down, got 70 from an institution. They fixed it, flipped it, and sold it for $50,000 profit. Well, because it was 70% debt leveraged, 70% of the income that the IRA is making is subject to that UBIT taxation. Right now, notice this is a tax not paid by the individual. It's a tax paid by the IRA itself as an entity. Right, so no money is coming out of your pocket. Right, it's the IRA's funds, and notice it is only from the profit made, not from the overall investment. So of that $50,000 profit, 70% of it is taxable, so 35,000 of it is taxable income. Okay, so in this example, it gets taxed at trust rates. The IRA pays it via 990T, and that's it. It keeps the rest, comes back to the IRA, and the IRA can redeploy it as they see fit. Now let's take that same concept though and put it in a syndication. So syndication goes out, and let's just say, just for ease of numbers, it was still 70% debt leverage. This, you guys borrow 70% from an institution, the rest came from private money. Well, awesome. The IRA makes its investment. Over the years, as it's receiving its K1s, right, the IRA doesn't have any taxable income, right? If I wasn't doing it as an individual, making this investment, and I was a full-time real estate investor, I could take that K1 and claim it against my taxable income. Right? But the IRA hasn't received any of that income yet. So all it's getting is those negative K1s, and it's going to hold on to them. All right. So let's say the first 3 years gets the negative K1s, fourth year, it's a negligible amount, fifth year is when you get the full return on investment. Okay. Well, let's say, again, makes $50,000 profit, so 35,000 of it is now taxable. Well, because the IRA has taxable income now we can utilize these K1s that we've been receiving, right? That shows that forced depreciation on there.
That's
so we're
right.
going to take that forced depreciation, apply it against the taxable income that the IRA is experiencing to knock it out. Sometimes it knocks it out completely. Sometimes it leaves a negligible amount, right? It really just depends, obviously, from deal to deal. But I will say that while I'd say 95% of syndication investments bring on UDFI because they're usually using institutional funds, it's the most common investment we see here at Quest. Why? Because a lot of times that forced depreciation will knock out a lot of that taxable income to a point where you're paying minimal amounts and you get to keep the rest and redeploy as you see fit.
That's right. I think that's really powerful. The fact that, you can grow your retirement savings, tax-free. And even if there's UBIT, UDFI, if you have self-storage investments, the operator should be taking advantage of cost segregation, therefore issuing depreciation on your K1s. You can therefore use this to against the gains that you're getting from either real estate or maybe you invest into a hedge fund, right? With Quest Trust. And because you have that diversified portfolio, at the end of the day, you're minimizing your tax burdens. So I think that's really powerful.
Exactly. And that's why we always try to tell people is that when they first hear that, taxation and what an account that I thought was a tax-free account, or I also tell people it's not something to necessarily be super concerned about. You just want to be aware of it, right? You just want to be aware so that you're working with that syndicator, making sure you're getting those K1s, right? Making sure you're keeping them stored so that when the time comes, you can work with that CPA, make sure everything's getting reported. You're knocking down as much as you can so that the CPA can help you fill out a 990T, whether it be to actually make a payment or to report that there's nothing to be paid on it, and you can move forward from there.
That's right. So on the obviously the K1s are issued from the operators, from the syndicators. But for our investors to figure out, okay, the UDFI, how much depreciation they're able to use, is it their own tax accountant that's helping them figure that part out, or is their platform able to calculate that for them?
So right now it is the CPA that's going to be helping them out. We are in the works right now on a platform that will group in UDFI calculations. We work with some really smart people who are kind of leading the industry with the technology as far as making that calculation. But for right now, it is going to be working with your CPA to figure out exactly what that tax burden is.
Awesome. Yeah, that's fair enough.
All right. So guys, I mean, that's really, kind of the gist of what a syndication investment looks like within an IRA. By all means, reach out to me if you have any questions at all. Yeah, I mean, I really love talking about this kind of stuff, especially, it sounds lame, and I don't think I can go to a bar and exactly start this conversation, right? But I honestly do enjoy it. Just because you'd be surprised how creative you can get with an IRA. Like I said in the beginning, most people think that, oh, I can put my IRA into stocks, or I can put it in a 401k, put my funds in a 401k and just, cross my fingers, hopefully it grows fast enough and does what I need it to do, right? And I'll just tank the downturns in the market. But there's alternatives, and I think that's something that 5 years at Quest has really opened my eyes to.
That's right. Yeah, Zach, I would definitely talk about this with you at a bar, so don't beat yourself up over that. But lastly, I was just wondering, do you have any stats regarding, hey, this is how much an average American is making, through their IRA, if they're just, on the employer plan, or just have someone else manage it, versus if they're in a self-direct IRA environment, how much you're able to make? Would you happen to have that stats?
No, so it's actually pretty hard to get those. Believe it or not, we as a custodian, we do have to report the value of all assets under administration, every single year, which is why we have our FMV process. But a lot of other custodians will take their time when doing so. It's not exactly due immediately. We try to get it done as quickly as possible, just because the Texas Department of Banking is one of the strictest in the nation. So there's no stats telling you exactly how much people are averaging within a self-directed IRA, just because one thing you have to consider is that a self-directed IRA can also apply in the public sphere, right? I can have a self-directed IRA at Fidelity. So there's no real way to break that down. I will say, I think it was something ridiculous that only like 2 to 3% of all IRAs are what's considered self-directed, but I think it's like of all IRAs valued at 5 million or more, 27% of them are self-directed. Right. Wow. So the large portion of the higher value ones are self-directed, just because you have the freedom to get creative and do what you want with these investments.
That tells a really good story. Lastly, what are the costs associated with this for our investors if they're looking to leverage your platform, invest into not just my self-storage opportunity in El Paso, Texas, but other opportunities that they might come across? What are the costs associated with working with Quest Trust?
Yeah, so it's going to be $100 to establish the account. Right after that, these next fees wouldn't be incurred until we actually funded the investment. Right. So the first one is going to be $125 asset purchase fee. Now, what that covers is us assigning that specialist, working both with you and with the client to help gather up the documentation, going through the full audit process, both with our private entities team, and then it also has to pass through to what's called our quality control team. That is our back-end auditing, that last pair of eyes to make sure everything is, all I's are dotted and T's are crossed. So that's what that 125 covers. Sending the funds out as a wire is a $30 charge. That's what we get charged by the bank. And then those are just the one-time fees. The only recurring fee that they're looking at is the annual administrative fee. Now, this one will depend on the value of the account, but the maximum that it could be is going to be $350 per asset per year. So any one of your clients looking to bring over funds for this single investment, they're looking at a maximum of $350 a year. It could be $1 million that are going to the Quest account and going into your fund, still just $350.
Right. So I'm not sure if you're familiar with any investor portals, but for us, we work with InvestNext, and there is a natural integration with most of the major financial institutions where investors can directly wire money out of their checking account into the bank account that we have with InvestNext. Is that something they're able to do as well? If they work with Quest Trust and have a self-directed IRA, or like what do the logistics look like?
Yeah, so unfortunately, not really. It's just not something that we were really set up to do. And kind of just as a little bit of a peek on the back end, why is that what we do is on all the funds that we have here at Quest, right? Keep in mind, a lot of them are not liquid. A lot of our clients will have accounts, and in fact, we encourage them to only bring over the funds you need for the investment, right? Why? Because these are self-directed accounts. That means they're not interest bearing. So we don't have cash just sitting with us, right? But for the clients that do have cash sitting with us, we always wanted to be sure that we never put in an account that could not be fully covered by the FDIC. All right. And what that meant is that we had to build a network of accounts that has multiple banks. That way, no single account is ever holding more than $250,000. So that's why it's kind of hard for us to set up. We're not just operating out of one large account that we can just fund everything through. We handle that end on our back end so that, if everything were to go wrong and banks were to fail, Quest were to close, all of our clients are protected. Everyone's going to be fully insured. And so kind of how it works is that when you're meeting with that private entities team, that private entities team is going to look over all the documentation. While they're doing that, they're working with our quality control team. The quality control team is the one with access to the operating account that money gets pulled into. From there, they're going to be the ones releasing the wires out of there. So we can have that wire released in 24 to 48 hours from getting the investments in good order.
Got it. Yeah, no, that totally makes sense. Thank you so much, Zach. And thank you for having your email here. So if any of the investors are looking to do something more with their registered funds and beef up their retirement savings tax-free, definitely reach out to Zach. We've done our due diligence as well in choosing a platform that aligns with the vision that we have. And we felt like Quest Trust would be the best equipped team to help our investors to achieve that. So no, thank you so much, Zach, for taking the time with us.
No, I appreciate you bringing me out. And yeah, like I said, we really do enjoy doing these classes. If ever your investors are wanting to take a deeper dive into any other aspects when it comes to investing into self-storage syndications within an IRA, by all means, let me know. We'll be happy to kind of meet with a bunch of people or just hop on individual calls.
Perfect. Awesome.